Hey everybody, good to be here today. My name is Brent Moores. I'm sitting in for Cam today. We're talking about getting started with options. Today we're going to go real basic. I'm assuming you know not much of anything about options when we're going to be talking about this today. So that's what we're going to be talking about. We're going to be talking about long calls basically from a complete beginner standpoint. We'll be doing that in just a minute. I see some familiar names in the chat. Glad to have you here. And if you're new, we're glad to have you here as well. So I'm joined by Mike Fairborn in the chat, by the way. Mike and I have been working together about 20 years now, and not just that, he's also a good friend. So he's a good guy and he's a good instructor. Make sure you check out his ThinkScript class. He teaches on Thursdays at 3 o'clock Eastern time. And that's recorded as well, archived like most of our webcasts. You can follow us on X at BrentMooreCS, at Mike Fairborn CS. So there you go. Let's hit a few disclosures, then we'll get to the heart of the matter here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only, and should not be considered an individual recommendation or endorsement of any particular strategy, chart pattern, or particular security. And while this webcast will discuss technical analysis, we don't recommend that technical analysis is your sole means of investment research. And we'll look at individual symbols here, but those symbols are not recommendations. All investing involves risk, including loss of principal. We're going to be talking about long options today, but just remember short options can be assigned at any time up to expiration, regardless of in-the-money amount. We'll briefly mention some option Greeks here today, so you may want to look that over. And the paper money software application is for educational purposes only. Successful virtual trading during one time period does not guarantee successful investing of actual funds during a later time period. Market conditions change constantly. You guys all know that. And stop loss orders do not guarantee an execution at or near the activation price. All right, hey, let's head on over to the Thinkorswim platform. That's what I'm going to be using today. For those of you who aren't familiar with it, this is available to you. Just go to the Schwab website, and under the trading tab at the top, you can download the Thinkorswim platform. So as I mentioned, we're going to talk about just the absolute basics of buying long calls here today. A couple of things to just realize. When you're learning options, it takes a little while, and there's a lot of different strategies. Don't try and learn every strategy at once, okay? So I'm going to start with a pretty basic one, long calls. There's other ones you could start with, but this is kind of a standard one that a lot of people talk about. And the reason people like long calls, or the reason a lot of people gravitate towards long calls, is it provides leverage. It gives you the opportunity to control 100 shares of stock with a smaller investment. So that's a good side. There's a bad side. There's cons too. We're going to talk about those as well. But let me just emphasize, this is not a get-rich-quick strategy, okay? So that's where we're going to start. But before we get too far into this, what I want to do is I want to just give you a few terms here, okay? So we're going to be talking about call options today. What are options? Options are just investments. They're derivative investments. By derivative, we mean their value is derived from something else. In this case, the underlying stock. So if you have XYZ stock and you have an option on that option, the fortunes of that option are largely going to depend on what that underlying stock does. A call option gives you, any option contract gives you the right, if you buy it, it gives you the right to buy or sell stock at a specific price on or before a certain date. A call option gives you the right to buy that stock. Now, what I don't want you to think about is just because you buy a call option doesn't mean you're going to buy the stock. In fact, most people who buy call options don't end up buying the stock. Most traders of call options just buy the call option, hopefully profit from the call option, and then sell that call option at some point in the future. That's what we're going to focus on today. But let me just give you 20 seconds here on put options. Put options give you the right to sell the stock, okay? And That's basically, just realize there's two types of options: call options and put options. And we're just going to be doing call options today, but I thought for completeness, I should probably mention what a put option is. We're also going to be talking about a strike price. That's a common thing. I'm going to be using that term. That's the price that we have the right to buy that call option at. Right to buy the stock at, excuse me, is the strike price. So I'll be referring to a strike price. It's the price you have the right to buy the stock at. And each contract, there's different contracts you can buy, different call option contracts you can buy. Each contract, you got to choose whether it's a call or put. You got to choose the strike price. You got to choose the expiration date. You got to choose the expiration date. Those would define the contract. The expiration date is the date it expires. It can be exercised early. You can turn the call into stock early if you want. Gives you the right to buy before the expiration date. But typically, that's not going to happen. That's not what we're looking to do. But when you're choosing the contract, you got to choose a strike price. You got to choose the expiration date, and it's going to cost you something. And that cost is what we're going to call the premium. There's a premium to it. I'll show you exactly where that is. A standard contract, and that's what we're going to be looking at today, controls 100 shares of stock. It gives you the right to buy 100 shares of stock. That's a call option. Okay. So let me give you an example here. And we'll look at real life examples here in just a bit, but look, just for this purposes, let's say we have a stock. Let me make this a little bit thicker for you. Hold on one sec. Try that. Let's say we have a stock that is $100. That's the stock price. Maybe we buy a strike price of $105. That would give us the right to buy the stock at $105. Well, that may not make sense right now, given that the stock's $100, but what if the stock goes up? And if it goes up a lot, that could be a good deal there. And we say that will expire in maybe 30 days. 30 days would be a typical type expiration. There's all sorts of expirations. You'll see those in a sec. And the premium you may see expressed as something like $3. Okay. Does that mean it only costs us $3? No, because there's a multiplier. And we got to multiply it by the number of, basically the multiplier, and that'd be 100. So really it'd be 3 times 100. So if you see a $3 premium, or if I talk about a $3 premium, it would actually translate to a $300 transaction. And I'm not going to factor in commissions or fees today. Just realize that, but they are there. So a $3 premium would be $300. If you see a premium of, say, 65 cents, really it would be $65 is how much that would cost you. Now, there are different reasons people may decide to buy a call option, but one of the main things is the leverage of them. You control 100 shares. In this scenario I just gave you, by the way, where we had that $3 premium and it cost us $300, that's how much we could lose on the trade, not factoring in commissions. The max you can lose, it's a defined risk trade. The most you can lose is the amount you pay. That's now you may go, well, that's like a stock. It is like a stock in that regard. However, keep in mind, there are some option strategies out there where you can lose more than kind of like your initial investment. So that's not what we're talking about here. Today, that's what we're talking about, is that's the most you can lose. So let's move on here. What are some pros and cons here of this? So let me just go through some pros and cons, and then I want to go to the Thinkorswim website, Thinkorswim platform, excuse me, and show you a real life example. Why do people trade call options, long calls? Well, you have limited risk. Now, that may sound kind of funny because I say that, because you can actually lose everything you put into it, but you can't lose more than that. I already mentioned that, okay? Limited risk. Leverage. And I'll show you that leverage here in just a little bit. But by leverage, I mean you control 100 shares. 100 shares. That's and for a smaller investment, that can be pretty substantial. Now, leverage, it can work both ways. In fact, when we go to cons, we'll mention that leverage here again. But that's because it's a pro or a con. Because as I think a lot of you know, leverage is great when it works for you, but it works against you, it's not so great. With that leverage, you have a large upside potential. Now, does that mean you're going to do this on every trade? Probably not. This would be for those trades where you're willing to be a little bit more speculative on the trade. That's when you would do this long call. Okay? And there's no extra margin required. The cost of the trade is what you need on that. Now, you do need to be approved for options. And so if you haven't been approved for options, you can't just go out and trade these in your account. So that would be kind of like a first step. But I would always encourage you, we're going to start with paper money. Start with a simulated trading platform rather than the real deal here when you get started on this. Cons. One of the cons, time decay. It works against you. If the stock is not going up, the option is probably going against you. The time decay eats away at the price, at that premium. If you have that $3 premium up front and the stock doesn't go anywhere, I'm not saying it goes down, let's say the stock just goes sideways, that $3 premium is probably going to go down in value over time. So that's time decay. We call that theta. That's one of those option Greeks. We'll try and get to some Greeks later, but I don't want to confuse you too much. Just consider it time decay right now. Okay. So the implication of that is you need to be right on direction. You want the stock to go up, and timing. It needs to go up in a certain amount of time. You've got an expiration date on this. So that's important as well. These can expire worthless. Okay? These can expire worthless. And these are, we'll just say, leverage can work against you. We know that. And finally, they're more volatile. More volatile than stock. Okay? So these are pros. These are cons. Why wouldn't you do these all the time on everything? Well, a lot of it is time decay, right? If you think that stock is going to go up, that's great. But very often, if you bought stock, a lot of times it doesn't go up. Maybe it goes sideways, or maybe it goes down. Let's say it goes down. You're probably going to lose money. Let's say it goes sideways. You're probably going to lose money. So from that standpoint, we'd probably consider this to be a lower probability trade. A lower probability trade. Alrighty. Now, let's go and let's take a look at that Thinkorswim platform. Okay. Let me move this out of the way. Here's your Thinkorswim platform. And I'm just going to pull up a stock. I've got JP Morgan up here. Okay, here's JP Morgan. And what I'm going to say is this. I'm going to say, you can see the stock. It's kind of gone up, it's gone down, it's gone up, gone down, gone up, down. Looks like it may be bouncing here. Can you see that? So for some traders, they may go, hey, I think this is going to go up to we'll say 325 area, kind of about there. Maybe we want to speculate on that. And this is going to be where we can see some of the differences between buying the stock and buying a call option contract on this. How much would it cost to buy 100 shares of a $305 stock? Well, it cost us $30,000 plus a little change there. Okay. So that's quite a bit of money if I wanted to buy 100 shares of stock. I can still control that by buying a call option. We'll see what that premium here is in a sec. But the first requirement is we think the stock's going to go up. If you don't think the stock's going to go up, you're not going to do it. We're going to say in this case, I'm just going to jot this down, we think it may go up to 325. I wanted you to show you what kind of change this could potentially make if the stock were to go up to 325. The stock's at about 305 right now, so we're talking about a $20 increase on this. It's a more expensive stock. So we're going to look at the option chain here. Go to the trade tab. If you have it shrunk down, you can go right here, option chain. And we can go here and you can see there's calls on the left side of the page. All these over here are calls. Puts on the right side of the page over here are puts. Here's strike prices. Remember, this is the price that we have the right to buy the stock for, even though it's likely we're not going to do it. And I'm just going to go what we call the at the money contract. The at the money contract, another term. There's a lot of terms with options, but it's the one that's closest to the current stock price. What's the current stock price? 305. What's the at the money contract? 305. I'm just going to use this for our demonstration purposes right now. Okay. And I'm actually not going to go out. Let me do this. Remember, we have different expiration days. I'm just going to go out about a month here. Okay. Notice that says 31. 31 days till expiration. March 20th. I'm going to open this. I'm going to go to the 305 strike price. Remember, calls are on the left. I'm going to go over here. And I just want to look at this here. How much is it going to cost me? Well, it says $11.65 for that ask price. Don't look at that. $11.65 for that ask price. Well, remember, we got to use that multiplier. And so that means we're going to move that decimal point over 2 spots. It's going to cost us approximately $1,165. Now, we may be able to pay a little less than that, but that's going to be our ballpark figure. Now, you may go, that's a lot of money. That is a lot of money, but we're controlling 100 shares of stock. And remember, that 100 shares of stock would cost us over $30,000. So from that perspective, it may not be as expensive, but this is a more expensive option because it's a more expensive stock, and generally there's a correlation between those two. That's what it would cost us. If we do this, we could lose every bit of that. We may put in a stop loss, but stop losses don't guarantee we're going to get out at a particular price. But for our purposes here, let's just kind of see what prices this could go to. And what I'm going to do here is I'm going to look at a tool that we have on here on Thinkorswim called the Theo Price Calculator. You can just pull this tool up right here. Just go up to Theo Price Mark right there. Click on that. And then you can click over here where it says Theo Price. And we said, what if the stock goes up $20? I'm going to just add a plus 20 in here. Okay, a plus 20 in there. And we're going to say, it's not going to happen instantly. Let's give it a couple weeks here. So instead of February 17th, I'm going to go out to the first Tuesday of March 3rd. And let's just kind of look at this. Let's look at that call option and look at what the price has done on this. This was the $11.55 is what is going to cost us. This gives us the mark price or the mid price of $11.30. We may be able to buy for a little closer to the $11.30. But the point is, this estimation, it's not an exact perfect indication, but it's an estimation, is that that option would be worth about $22. In other words, we've almost doubled the money on the call option when the stock went up $20. How much is that? Like 7% maybe, something like that? Stock goes up 7%, we've made almost 100% on the option. That's why people like doing long calls. Remember, there's pros and there's cons. We could lose this full $1,155. But I just wanted to show you that's what the leverage is. That's why when people are more willing to speculate more and they see numbers like that, they go, hey, this seems attractive. Now, 100% may be, we're not necessarily going to shoot for 100%. We'll go through some other examples where we won't necessarily plan on getting 100% on this, but just realize that. Now, I also said this is kind of a wasting asset, or in other words, time decay works against us. Let's do this. Let's use this little tool here. And by the way, there's a survey link in the chat. We appreciate your feedback. Let's use this tool and go through some different scenarios. And you can do this by yourself too. You can look at different call options, or if you want to, put options or whatever, and see what happens to the price under different scenarios. I'm just going to click on this and I'm going to reset it. What if instead of it going up $20, what if it goes down $20? Well, it's not going to be good. I'll tell you that. We'll see. Let me go out. I'll just go out to the end of the month here real quick, because I think it's going to be end of the month, goes down 20 bucks. We're starting with over $1,100 of cost. It's down to about $200. Okay. So that is showing how much you can quickly lose on this. And it could go to zero too, right? Now let's do another scenario. Let me reset this again. Let's say instead of up $20 or down $20, it stays exactly where it is, but we go forward a couple weeks in time. I think that's March 3rd. Let's see what happens to it. No price movement. If you bought the stock, you'd still own the stock at the same value that you bought it for. But on this option, it will have gone down from roughly $1,130 to $840. You've lost money. That's the time decay. That's why you can't do this on everything, but you only do it when you think it's going to be more likely to go up, and you're willing to speculate, and this probably isn't like money you're banking on for retirement here or anything like this. This is a little bit more speculative there. Now, I chose March 20th, out a month. Notice we could have chosen these other dates here. Some of these are in white, some of these are in yellow. The yellow ones are just indicating these are weekly contracts. Doesn't matter, they're just different expiration dates here. Okay? But sometimes these monthly contracts are a little bit more liquid. More people are trading those, so you're likely to get better pricing on those. So I don't want to go too far into that right now, but that's the contract. And notice you can go out way in time, 1,000 days into the future. Okay? It's going to cost you more if you do that. I mean, go out 1,000 days in the future. How much is that 305 going to? We don't have a 305, but we'll say a 310 going to cost. It costs us like $6,000. Well, you're holding it for 3 years basically, so it's going to cost you more. That's how options work there. Now, let me hit some questions up, and then let me just mention one more thing before I do that, before I hit the questions. I chose out a month. Now, we had another choice to make on these calls. Remember, calls are on the left side of the page. There was a lot of different strikes. What I did today was I went with the strike price that was at the money, the 305, because the stock was at 305. You can go with strike prices that are less than the current stock price. We'd call those in the money. You may hear that term, in the money. In the money, strike price is less than the current stock price. That's for call options. It's different than put options. Put options is just the opposite. We could have gone out of the money. Out of the money means the strike price is higher than the current stock price. And so these are generally deemed to be a little bit more aggressive. Okay. you need a bigger movement for these to be profitable. I said we're going to start off with the at the money contract. Sometimes when you're starting out, if you're just kind of starting out and playing around with paper money, and that's what I'm on. I'm doing paper money here. This is just a simulated trade. But sometimes when you're doing this, what you will have is you'll go in the money a little bit. Not much, just maybe a couple strikes in the money, and you can do those. Notice it'll cost you a little bit more in that case. All right, now let's hit some questions up. And then I want to talk about some other things. Talk about Greeks. Okay. Questions. Can you explain the Theoprice stock? Okay, Theoprice. You go up here. It may not say Theoprice right here. It may say something else for you right here on your Thinkorswim platform. It's clickable though. You can click right here and change it. And so when you go to it and you choose Theoprice, it has this right here. You just got to click on it and you reset it in case you've used it before, and you can change the date. Remember, because there's that time decay, the date you choose to look at the future option price matters. Okay? The longer the date goes, the less that option the longer in the future you choose, the less that option is going to be worth. You can choose your stock price adjustment. You can choose it to go up or down. Just put a plus or minus sign before the number. You can also use these little tools to go up or down that way too. Okay. You can also adjust implied volatility. I don't want to complicate things right now, so I'm not going to adjust implied volatility right now on this, but that's what this is. All right, let me just see other questions. Okay. So did I invert the in the money and the out of the money? These are in the money. Okay, did I write it wrong? These are in the money. When the stock price is above the strike prices, and these are out of the money. Okay, these are out of the money. If this is like your first time with it, don't stress too much of in the money, out of the money. Just know, those are some terms. Here's our at the money. The in the money contracts are always going to be more expensive than the out of the money contracts. In the money are always going to be more expensive than the out of the money contracts. If you're looking at puts, and again, we're not focusing on puts today, but that's true. These are going to be in the money for your puts. They're more expensive. For the puts, the out of the money are going to be cheaper. All right. Another way, yeah, I think I'm going to leave it at that. All right. Let's see. Hopefully that answers your question there, Alex. Good question on the stock price. And so on this Theoprice, play around with it. Just look around at it. Remember, you got to look at the Theoprice column. You can adjust this all day. And if you're looking at the mark column, it's not going to change. The mark is the current price. The Theoprice is the theoretical future price there on that. Okay. So let's talk about Greeks. There's things called Greeks, option Greeks. Option Greeks are just mathematical measures of movement. Okay. You're driving a car, you can say, I'm going 50 miles an hour. It's just a measure of how fast you're going. Your Greeks are a measure of how the option can change. And so for our purposes right here, I want to talk about delta, theta, and vega. Now, again, if you're starting out with options, don't worry too much about this, but I think the discussion would probably be incomplete without at least mentioning these. So what's delta? Delta tells how much that option price is going to move in relationship to a $1 move in the stock price. Stock price goes up from $305.70 to $306.70, a $1 move. That option price is going to go from $11.55 up to, you move by the amount of delta, of just a little bit over $12. Okay? It shows how quickly it moves. So we say it controls 100 shares and it's leveraged, but it doesn't move the exact same amount. I mean, if this goes up $1 for 100 shares, that's $100. If it goes up $1, we're only making $54. We're only getting about a $54 benefit here on the option, but it's costing you so much less for the option than it is the stock. That's why it's still a leveraged move there. That's what delta is. It tells you how much. It tells you how much the stock is going to move. Excuse me, the option is going to move in relationship to a dollar price. Okay. So, question: does the Theo price correlate to with the delta? Good question, Momo. Yes, because these that have, let's say we adjust our Theo price by, I don't know, $3. Okay, let's say we say it's going to go up $3. If I'm choosing something with a 77 delta, we're going to see that option price change by about, I don't know, 230 or something like that. Okay. If we choose the one with the 54 delta, and we're saying the underlying stock moves $3, we're going to see the option price move by about 165 or something like that. See that? So yeah, each of these change. The prices change by the amount of the delta. Again, if you're new, I don't want you to get bogged down with that, but it's something that you're going to need to know eventually there, okay? There's other Greeks, and I hope that answers your question there, Momo. Theta, we mentioned time decay. We mentioned each day that goes by, the price is going down. It's working against you a little bit by about 17 cents there on the premium, by about 18 cents there. Depends on what strike you choose. Now remember, we have that 100 multiplier, so this would be $18. $18 on this $1,165 contract. That's how that works. That's how the time decay works for you. It works against you each day. Now, just because a day passes, are we going to see this price go down by that much? No, because the delta is doing something. There's other things there's a lot of moving parts here. If you could freeze all those moving parts, though, and just look at the time decay, that's kind of pretty close to what we'd see. Now, there's one other Greek we should probably mention here, and that's Vega. Vega tells us how much the option is going to move in relationship to a move in the implied volatility of the stock, of the option, okay? So in other words, there's some options are more expensive than other options. And a lot of that is derived by how much potential movement there is in the option. A stock that bounces around a lot, I don't know, what's a stock that moves around a lot? Tesla, maybe? NVIDIA? I don't know, you can think of some that are moving around even more probably. They're going to have higher implied volatilities. It's just the options are going to be more expensive. Stocks that don't move around much. Think about kind of an old blue chip stock that just hardly moves. It's just, people buy it and maybe they want to collect their dividend or something like that. It's probably going to have a lower implied volatility. They're going to be cheaper. Those options are going to be cheaper. But over time, those implied volatilities can change. Here's the implied volatility of JP Morgan. Notice it's gone up. It's gone up from, I don't know, 23 maybe, up to about 32. It's gone up about 9 points. This can affect the option price as well. How much? By the amount of the Vega. So let's say it goes up 5 points. Well, my Vega is about 35. 5 times 35, that'd be like $1.65. It would adjust, it would change this price. These are the three main Greeks here: delta, theta, vega that we're going to talk about. One way to remember these is PTV. Price, that's the stock price. Time, that's them every day that passes. And V for volatility. V, vega. Both start with V, right? Vega, volatility. Time, theta. Both start with T, time and theta. It tells us how much that time decay is going to affect the option price. D, well, that's the stock price. D, direction or stock price there. So that doesn't have the nice little starting with the same letter there. But that's one way to kind of remember the three biggest factors. But I'll tell you what, in general, the biggest factor is that stock price. If the stock price goes up a whole bunch, the time and the volatility probably isn't going to affect it as much. That's what you're banking on if you are buying a long call. Similarly, if the stock price goes down a lot, it doesn't matter what your implied volatility is going to do. You're probably going to lose money if the stock goes down a lot and you've bought a long call. All right? Now, let me just pause real quick. If you have questions, now's a good time to get those in because we are running out of time here before too long. Okay. What are some common errors that people make on this? Let's look at a different example while we do this. Okay. So let's look at maybe something that's not moving as much. Let's do Bank of America. Okay, I'm going to take Bank of America and I'm going to say, oh, Bank of America, cheaper stock. It's around $52.50. Let's say we think it's going to move up to about here. Now, obviously, if you think it's going to go down, maybe you think I'm wrong, you want to do this. Okay, we're going to assume it's going to go up here, a few dollars, maybe not even that much, whatever. But let's say it's going to go up to about, we'll say it's at 52.78 right now. Let's say we go to 55.78. So that's a $3 move in this. Well, how could we do it? Pull up Bank of America, and you can choose your strike price. And we can do that theoretical tool thing as well. We're just going to reset it. We're going to say stock goes up $3. We'll say it goes quick. I'm just going to go out a week here. And I'm going to leave the volatility here. And I'm going to go at the money. Well, let's see. We got a 52.50 strike. That's at the money. Starting out at 186, it would be worth approximately, it's an estimation, 373 after that. Okay. Now, if we were to say it takes 2 weeks to do that, it would be a little less because of that time decay. If it goes down $3 instead of up $3, certainly possible. I could put a -3 here, get an estimation of what it's worth. And we could say, well, it'd be worth about 50 cents or $50 after this. Buying it for $180, selling it for $50 or so. So if you want to buy something like this, you can just simply click on the ask price. And I encourage you in paper money to try it out. Try it out in paper money. And then, you just click on the ask price and it's going to bring it up just like a stock. It'll give up the basic parameters. It'll show you this. And if you wanted to do a stop loss, you'd do it the same way you would do on a stock. You can right click on it. You can buy custom with the stop. Here's the buy order. You can see the prices here. There's my buy order. Here's my sell order. Now, I'm going to put that sell order in about half price, maybe just a little bit more. Now, normally, if you're buying a stock for $50, you probably wouldn't consider putting a stop order down at $25. Maybe you would, I don't know. But that'd be kind of a very loose stop. With options, because they're more volatile, you can't have a tight stop, as tight a stop. Okay? They're more likely to just get triggered out almost instantly if you put a stop within 5% of the purchase price. So in this case, I'm going to put the stop in right about $1 here. right about $1. And I'm going to make that stop good till canceled. And then what I'm going to do is I'm going to confirm and send. Okay. And I'm just going to make sure you read it over. Make sure you read over everything. Max profit, infinite. Don't bank on it, folks. Don't bank on it. That's if it goes up. Now, the scenario we worked on, it actually showed a pretty nice profit if it went up as far as we said. But remember, that's not the most likely scenario. It's not likely it's going to go up a whole bunch. But if we're willing to speculate, max loss, that doesn't factor in the stop loss. Remember, stop losses don't guarantee to get us out at the activation price. It could go down to zero. That's our loss on this. And then we could send that trade, and we just sent that trade. And when we look at it, let me get here. Here's Bank of America. Here's our trade. This is what it looks like. It's Bank of America, and it gives us our example trade here. Quantity, quantity of one, okay? We bought it for 186. Currently, it's 183. It ticked down just a little bit. We're down $3 on this. When we want to get out of this, we can get out of this. The goal here is not to exercise it necessarily, at least that's not how I'm teaching it today. We would just look to get out. We've got the stop loss. If we wanted to get out of this stop loss, and I can cancel the stop loss, just right click on it, cancel the order. And then I can say, well, I want to get out of this trade. I'm going to right click on it, create a closing order, and sell this. Okay. I'm going to look to sell it. We're selling for 181. So we'll take like a $5 loss here on this right now today. Okay. Let's take a look at it. Bank of America, $1 loss on that, I guess. Okay. We got out. So that's because we held it. Our goal, I just wanted to show you how to buy and sell. I'd encourage you, though, in paper money to try it out. That's how you learn, by trying things out. Let's look at one last one, and I'm not going to have time to go through the whole thing here, but let's look at Occidental Petroleum here. When you're buying a call option, you want the stock to go up. One of those factors you may consider is the trend. Hey, it's trending up. The two examples I gave you, I bought out just a month's worth of time because we were looking at more of like a shorter swing trade. If it's going to trend, maybe this is a trend trade and we think we're going to be in this for 2-3 months, something like that. That's fine. We can buy more time. Let's go to Occidental Petroleum. Let's go out and look to buy more time. Let's go out 59 days here. Again, maybe I'll go just a little bit in the money. At the money is 45, in the money's here. We'll look right here. If I wanted to buy it, I could just simply click on it and buy it. And then confirm and send, adjust the prices like you would there, okay? Now, we're going to look to get out before expiration. If we didn't get out before expiration, if it's in the money, in other words, if the stock price is above our strike price, it will be auto-exercised unless you've given instructions not to. If it's out of the money, it won't be auto-exercised. It would just expire worthless. Hopefully, we don't let it get to that point. Just because we pay, let's say, $450 on this, I don't want to lose $450. That's the max potential loss, but we're going to do our best to avoid that. So we're going to try to get out before that. If it starts to look bearish, if the trend on Occidental Petroleum breaks, we'd probably get out early. Some common maybe mistakes. Looking for these cheap options out here, way out of the money. Ooh, it's enticing because they're very cheap. Often buying far out of the money options, they expire worthless and you lose it all. So that's not the standard way I want you to start doing that. Don't hold it all the way through expiration. That's not what we're going to do as we're doing these examples in this webcast. Typically, we're going to get out before that. Realize if the stock's not going anywhere, it's probably working against you because of that time decay. Because of that time decay, because of the theta. So there you go. These are leveraged trades. Remember, this is not intended for the majority of your account. This is intended for the more speculative, aggressive parts of your account. So therefore, apportion risk size, position size appropriately. Position size to what you're willing to lose. This is long calls, folks. This is just meant to be a basic introduction. Use your paper money to try them out, to experiment with them, everybody. And there we go. That's all I have time for. Hopefully that helps you as you're getting started out. Play around with it. Thank you for joining me. Cam should be back next week. But in the meantime, I appreciate you joining me. Make sure you follow Mike and I on X, at Brentmore CS, at Mike Fairborn CS. Thank you, Mike, for helping me out. And thank you for all joining me, everybody. Have a great rest of the day. Bye-bye.